Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. Welcome you out for a wonderful show that's for you and about you. Those of you that work so hard for your money and you're ready for your money to start working harder for you now. You want that freedom, that cash flow, that prosperity today, not 30 or 40 bazillion years from now, but right now. So you can have that life that you love, doing what you love, being with those that you love. But on top of that, it's not just the fact that you want to be prosperous yourself and that you want to live a comfortable, amazing life. But on top of that, you actually want to become a rippler in the sense that you want to create a ripple effect through others' lives, because as you're blessed financially, you can bless the lives of those around you as well. And that's the thing I love, that you guys are creating a legacy, that you're creating real impact by blessing more lives. And I appreciate you guys following, you're binging, you're doing everything that's awesome. I appreciate you guys sharing this with everybody else. I love watching the show grow, and you guys are a big part of that. So thank you so much. As a reminder, you can check out our website, moneyripples.com. There's, again, that ebook, Beyond Rice and Beans, 7 Secrets to Free Up Cash Today, you can check out and download for free. So go look at that. So today I've got a special guest here. And again, you guys know I don't bring on guests lightly, right? I want to make sure that I bring on real deals, not just posers, but people that actually are walking the walk and talking the talk. And right now, I know a lot of questions that are coming out from both my clients and just others in general, or people saying, well, real estate's horrible right now, right? Like, we should probably just be, putting more money in the stock market because it's low, even though it's way lower is the potential for what the market has to go. But people will say, oh, don't do real estate. That's got to be horrible right now. Well, I've got a guest here, Paul Moore, who's been in the industry for a long time. Now, Paul took a different path in the beginning, kind of like a lot of us did, right? He graduated with an engineering degree and an MBA from Ohio State. And then he started on the management track at Ford Motor Company in Detroit. But after 5 years, he decided to leave that job, and he started doing a staffing company, which he was able to sell for $2.9 million to a publicly traded company. Along the way, he was the finalist for the Ernst Young's Michigan Entrepreneur of the Year for 2 years straight. He also later entered the real estate sector, where he completed 85 real estate investments and exits, appeared on an HGTV special. So some of you guys may have already seen him. Rehabbed and managed dozens of rental properties, developed a waterfront division, and started 2 successful online real estate marketing firms. With 3 successful developments, including assisted in development of a Hyatt hotel and multifamily housing project, this led him into the multifamily arena, right? Which is what we're kind of talking about today. He also co-hosts the Wealth Building podcast I invite you guys to check out, called How to Lose Money. He's also a contributor to Fox Business and Bigger Pockets, producing live video and blog content on a weekly basis. He's also the author of The Perfect Investment, Create Enduring Wealth from a Historic Shift to Multifamily Housing, and has a forthcoming book that we're going to talk about today on self-storage investing. So we'll hear more about that. And also, if that wasn't enough, he's also the managing director of 2 commercial real estate funds at Wellings Capital. So dang, Paul, take a break.
I know, man. Hey, why
I almost hyperventilated trying to give this bio,
I know. I got to shorten that, don't I, Chris? I've already got an edited version. But why would somebody who has a money show have somebody on who has a podcast called How to Lose Money? I'm just curious.
Probably because the same reason. I lost over $1 million in the last recession. That taught me great lessons. So
yeah,
we're probably in good company.
Yeah, probably, Chris. You got to come on our show. That's great. Yeah, man, it's great to be here. Thanks for having me on.
Absolutely. Well, Paul, outside of what I just shared on the bio there, tell us a little bit more about you.
Yeah, I think that covers it pretty well. I'll tell you this. When I sold my company at 33 years old in Detroit, I thought, I'm an investor now. But I actually became a speculator. I became a certified shiny object chaser because I really didn't know anything about investing. I didn't know anything about creating true wealth. The way I see things, Chris, is true wealth is owning assets that produce income.
Yeah.
And speculating is the way to get there occasionally, but not on a consistent basis. I think investing is when your principal is generally safe and it should produce income and might grow in value. Speculating is when your principal is not at all safe and it has a chance to make a return. And I found myself speculating and making money occasionally, but losing a lot of money along the way. And so I did that even when I got into real estate 20 years ago, and finally had a wake-up call after around 2011 or so, got into commercial real estate,
Hmm.
and have found that that is a great path. I mean, most of the Forbes 400 wealthiest people in the world invest in commercial real estate. And now I found out why.
Yeah. What you just said is a huge point. This show is all about creating more cash flow, passive income, but doing it in a way that's predictable, right? Like predictability is way better than speculating. And people will say, well, Chris, why don't people talk more about, doing predictable cash flow versus all this speculation? And I said, it's easy. Speculation's sexy, right? But you
Right.
think about it, like you never see people. I remember this 15 years ago with a lot of the info marketing type of groups and education programs that were more popular until the recession, right? But they would say things like, yeah, I made $50,000 on this flip or whatever, right? I say that's a lot sexier sounding than saying, hey, I'm earning $300 a month on this door here,
Right. Yeah.
It just
That's
doesn't sound
exactly
as
right.
good, as enticing for a sales job. And so, yeah, I agree with you. Like predictability and wealth creation's got to be hand in hand.
That's true. Babe Ruth is still famous over 100
Mm.
years later because he swung for the fences, but he was also the strikeout king.
Yeah.
And real estate developers and other people who do startups, they're some of the wealthiest people in the world when you hear about them, and they're legendary. But
Mhm.
for all those, 100 to 1 or 1,000 to 1 you don't hear about, they're probably delivering pizzas.
That's right. That's so true. So what have you learned, like as you got in this commercial space? Because I know a lot of people are scared to death to be in the commercial space. And so I would
Yeah.
love to hear what you're seeing and what makes you so excited for the next 3 years, for example.
Absolutely. So I'll get into a little bit about how I think the best way to buy commercial real estate is in a minute, but I want to talk about why the Forbes 400 invests in this, I think.
Mm.
So residential real estate, we all kind of know how it's valued. If you're Chip and Joanna Gaines Jr. and you can rehab a house, take a $300,000 house and, put in gold-plated fixtures, I'm kind of kidding, and finish the attic, finish the basement, put on an addition, and you dump 500,000 in it, you got 800,000 in this house. But if it's in a $350,000 neighborhood, you're probably not going to get your money out of that because residential real estate is based on comparables or
Right.
comps. Commercial real estate's entirely different. It's based on something that we love from school called math. Now the math works very simple. The value is the net operating income divided by the rate of return, also known as the cap rate. And
Mhm.
so if you can drive up the net operating income, you can sometimes shrink the cap rate, but if you can drive up the NOI, you can actually increase the value of the asset by that same proportion. And if you're using safe leverage, sometimes you can double or triple the value of your equity if you do it right. So the question is, how do we, well, let's first of all go through an example. Here's a real simple example. Let's say you bought a self-storage facility for $2 million.
Mhm.
And let's say you put $1 million debt on it and you put $1 million cash from you and your friends equity, in other words.
Mhm.
Now, if you go in on day one and you sign a contract with U-Haul and actually start renting trucks out of that facility, that will add $3,000 to $5,000 often a month to your income with no capital expense out of pocket.
Right.
Now, if you add, let's say the average $4,000 a month to your income, that's $48,000 per year, right?
Right.
Now, remember our value formula. Value is the income divided by the cap rate. Divide that by a rate of return or a cap rate of 6%. You just added $800,000 to the value of that facility. And that's, you just added 80% to the value of your equity of $1 million up to 1.8 because the bankers don't share in this.
That's
And
right.
so that's one of dozens of ways to add value. Now, the question is how to do it in a predictable way. And you talked about
Mhm.
predictability earlier, and it's really simple. Buy from mom and pop sellers, or if it's in multifamily, buy it from distressed sellers. And we're going to see some of those in the coming 3 years. If you
Absolutely.
buy from a mom and pop, they don't have the resources, knowledge, or the desire to maximize income and grow the value. And therefore, you can bolt on these value adds like the one I just described and dramatically increase income and value.
That's right. Now, why do you see that there's going to be such a big opportunity in the commercial space right now? Like, why do you see that as being the place to be for you?
Yeah, so I think residential will as well. It's
Hmm.
just harder to scale. I mean, I
Hmm.
just got off the phone
Yeah.
with somebody trying to raise $100 million distressed debt fund. It's going to be pretty hard to do that in single family, although there are
Hmm.
ways to do it. Commercial real estate, again, because of this predictable math formula,
Hmm.
and because there are still mom and pop sellers in certain asset classes like self storage, mobile home parks, they have a large percentage of the assets owned by mom and pop operators, and you can go in and significantly increase the value of those. And that's what I love about commercial.
And that was the kind of thing I was leading down the road to is the last few years, what have you seen with people buying these kind of real estate deals? 'Cause it seems like everybody, can come out of almost nowhere and they just go in and they say, hey, I'm going to raise money from a bunch of strangers and or my friends and family and just go do a commercial deal because everybody makes money in real estate, right?
Yeah.
It's almost like the last recession in some ways. But what do you where do you see that
Hmm.
opportunity? Like, what kind of people are the best people to buy them from? You mentioned
Yeah.
mom and pops, but where would be the signs that you see from those kind of buyers?
Yeah, well, the first thing I would say back to what you said a moment ago, and that is Warren Buffett said, everything looks great now. Everybody's a genius when the market's rising.
Right.
But someday the tide's going to go out, and then we'll see who is swimming
Swimming
without a
naked.
bathing suit.
Yep.
And I think that's about what we're about to see. Unfortunately, multifamily, just like single family real estate, got completely overheated.
Hmm.
People were paying stupid money. I mean, I know of,
Yeah.
deals that should have gone for 5 million that went for 7.
Hmm.
And some of those sellers are already starting to panic right now.
Yeah.
But one great way to buy those would be, going to a regional or even a community bank to
Hmm.
see what debt they have. Let's say somebody paid 4 million for a property, they got a $3 million loan.
Hmm.
Well, let's say that property, let's say 2 years from now, has dropped in value because, let's just say, because the net operating income dropped and the cap rate expanded,
Hmm.
meaning that the property dropped in value from 4 million down to just below 3 million, and it's time to refinance, and the property's not performing. Well, you might be
Hmm.
able to buy that debt from the bank for that $3 million loan for, say, 1.3 million. Then go to them, the seller, and say, look, I'm going to give you 6 months to refinance. If you can refinance, you can, I'll let you out of this $3 million loan for 2.2 million. If you can't refinance, I'll have to foreclose. And then you've got the asset for whatever I said, 1.3,
Sure.
1.5 million. And then you can take it over, operate it well, and ride it back up through the next cycle.
Hmm.
And maybe it'll be worth 4 or 5 million again. So it's a great way to go. That's one seller I would definitely look to. Mom and pops are another. There are 44,000 mobile home parks in the US, and it's believed that almost 40,000 are owned by mom and pop small
Wow.
sellers, only 4,000 by, professionally run companies. So there's a lot of runway ahead there in that area.
Sure. Now, I mean, obviously, with the timing it is right now, where this is early summer of 2020, right? From what you're seeing here, I mean, are there opportunities right now? Or are you feeling like, no, I got to wait a little bit and hold on my capital before I just jump in and start making these deals?
I have been talking about this on Bigger Pockets, and if you look at the last recession,
Hmm.
it took, can you imagine this? 3 to 3.5 years to hit bottom.
Yeah.
And so Howard Marks talks about the wisdom of catching a falling knife. A lot of other people say, maybe it's better to wait till the knife hits the floor. And so it depends if you want to catch it on the way down or when it hits the floor. Either one has some risk because you can't really tell where the floor is
Right.
except in a rear view mirror.
That's right. It's always hindsight 2020, isn't it?
Right.
Yeah. That's interesting. That's really interesting because I know some people are like, okay, they're coming, right? Like, how long should I wait? It's people say the same thing with the stock market. Like, I should jump in right now. It's you think the market hits bottom in a recession or even a depression, depending on what we go into, right? Do you think it actually hits bottom in 1 month? No, it's never happened and it never will.
Mhm.
It's not something that just happens overnight.
Right.
And so,
Yep, I agree. Yeah, it's one of the great things about real estate is we've got time.
mhm,
Even if you're a newbie right now, you've got time to assemble a team,
Yeah.
assemble your tribe, get to know bankers. You've got time to do this, a lot of time.
Now, what if somebody doesn't really want to be the active investor here? Like, I know some people are active investors that listen to the show, but there's a lot of people say, "Hey, between the job I work, if I'm working from home or whatever it might be, how do I really, do something like this where I probably want to be more of a passive investor, but I want
Yeah.
to be involved. I have money. I just want to know what to do with it." What would you recommend?
Yeah. So my new book on self-storage, the last 1/3 of it is dedicated to 7 different paths to get into commercial real estate investing. And one of my favorite paths is being a passive investor. You can either be a passive or
Mm,
a professional passive investor. And we have
right.
both. Invest with my company. A passive still should probably buy Brian Burke's new book called The Hands-Off Investor. It teaches you to vet a syndicator. It goes through a lot of checklists and things like that.
Mm-hmm.
We have checklists that we use when we vet syndicators. So as a passive, you should probably do that. If you're a professional passive, you should probably plan to do all that
Yeah,
and jump on a plane, go meet the syndicator in person, at least do a couple Zoom calls, see how
sure.
they talk about their investors, their family, their staff, see how they treat the flight attendant or the waiter. Try to really get a gut feel and then go through your checklist and really make sure you know them. And like Brian Burke says in his new book, the most important thing is their morality and their integrity. Better to have a mediocre deal with a great operator than a mediocre operator and a great deal, because a mediocre operator can mess up a great deal and a great operator can pull a mediocre deal into a great one.
That's so true. I've seen that a lot over the last almost 20 years now.
Yeah.
You see a lot out there today. I think that's
Yes.
a great idea too, just to really get to know the syndicator. Because one thing I tell people is that you can't teach, you can teach competence. You can train people to be more competent, to be a better operator, but you can't train character, right? You
Right.
can't train someone to be a better person. So you can't train somebody to have integrity. That's just something either you do or you don't do, right?
Right. That's
Yeah.
right. That's absolutely true. And so who they are when they're small and when they're alone is who they are. And so try to catch them at times like that.
Yeah. Well, great. Well, hey, tell us more about your book on self-storage, because I know that's something that's become a topic that people have started to ask me more about lately too, right? And I've had a few people on here about self-storage already, but tell us about your book and how people can get it.
Absolutely. So we were happily surprised the last 6 weeks to see that self-storage operators are reporting increased traffic. A lot of it's online, but a lot of people are renting online, and
Hmm.
self-storage occupancy is actually up, especially
Yeah.
near college towns and near
Mm.
bigger cities. It's not doing so well in the mom and pop rural areas where you have to walk in to rent the unit. But yeah, the new book's called Storing Up Profits: Capitalize on America's Obsession with Stuff by Investing in Self-Storage. And it's going to be published by Bigger Pockets Publishing sometime this summer. So, yeah, one of the things I love about self-storage is, generally speaking, not always, generally, it does well in good times and bad. In good times, people are
Hmm.
filling up their carts with stuff and they need a place to store stuff. In bad times, there's the 4 Ds. I hope I can remember them all: death, dislocation, downsizing, and divorce.
Yeah.
And people, when those things happen, sometimes they need a place to store their stuff. And for a relatively small amount of their total paycheck, they can store their stuff in self storage. If I raise your rent on an apartment or a single family house by 6%, you might walk rather than pay an extra $60 or $80 a month. But if
Hmm.
I raise your self-storage unit at $100 by 6%, you're probably not going to
Yeah.
spend a Saturday and move all your stuff down the street to save $6 a month, especially since
Yeah.
you're on a month-to-month lease. And if you're thinking like most people, you're probably thinking, I'm going to get that stuff out of there next month.
That's right. Everyone always thinks that somehow they're going to simplify and declutter and get their stuff out. And
Of
reality
course.
is that takes many, many, many years, if ever. It might be
Right.
death, right? Which is one of those Ds.
That's right.
So great. Yeah. We'll make sure that we get a link to be able to post on our podcast here, on our episodes, so people can go ahead
Good.
and get that book. That's great. That sounds really intriguing. So, well, Paul, I really appreciate your time today. Any final words for our guests or listeners here?
Yeah, I would just say that, again, like you said, it's the legends that speculate, and they're
Mhm.
few and far between. And if you want to make a consistent cash flow, whether it's in real estate or something else, go for the safe fundamentals. Warren Buffett was
Yeah.
asked by Mark Zuckerberg said, "Warren, your strategy is not that complicated. Why doesn't everybody just replicate it?" And Buffett said something like, "Well, no, 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 no. Why? Nobody wants to get rich that slow."
Hmm.
Well, Buffett's done pretty well for himself, and I think it'd be good to follow in his footsteps.
I agree. That's wise, wise counsel. Yeah, so, Paul, thank you so much for your time today. I really appreciate it.
Absolutely, Chris. Great to be here.
Yeah. Everybody else, make sure you go check out his book. We'll have that link in the show notes for you guys. But again, the time, it's good to be patient, but it's also good to be proactive. Do what you can now to build your wealth in your mind first, so you can build your wealth in your pocket second. So, everybody, I hope you make a wonderful and prosperous week. And we'll see you later.